Hello. Hi, I think we are live now. Good morning, everybody. Okay, today, welcome to the Investing Across Regions, our first online summit. So today we have Stanley, who is headlining the show. All right. Hi. Hey, Stan. Stanley, are you there?
Hello. Hey, Ethan.
Hi, yeah. Yes.
How are
Okay,
you?
awesome. Yeah, I'm good. How are you?
Very good.
Okay,
Thanks for
great.
the invite.
Hey, no worries. Yeah. So, of course, a lot of people do know Stanley, and for the benefit of people who don't know who Stanley is actually one of the top financial, bloggers and key influencers in Singapore. All right, but I think a lot of people might not know that Stanley is actually Malaysian as well. So he's actually quite well versed in both Malaysian and Singapore stocks. All right. So for the purpose of this summit, on his session, he will be speaking in English and presenting in English. Okay. So I think without further ado, I let Stanley take the mic, and Stanley, you can start. All right.
All right. Hey, thanks, Ethan, for the wonderful intro. Hi, good morning, everyone. My name is Stanley, and I'm the co-founder of Value Invest Asia. Give me a minute while I just start my screen here for you guys. Oops. I think, Ethan, you need to enable share screening again. I'm unable to share my screen here on my side. Okay, now it's better. Hope you guys can see this. Right, very good. Okay, here we go again. Hi, my name is Stanley, and like I said before, I'm the co-founder of Value Invest Asia. So before we begin, Selamat Hari Raya to everyone. And like what Ethan has mentioned, I myself is a Johorian, but have been working in Singapore for many years. So if you are also from Johor, comments down below, let me know, so at least I know some of my home buddies are with me today. But thank you for joining me this morning. I'm very honored, and I just want to make sure that I'm able to share as much as I can within this hour for you guys. If you have any question, you can just write it down in the comments here at any time, and then we'll try to get to that during the Q&A. Today, I would focus more on the key difference between the Singapore banks and the Malaysia banks. So what is the key difference between these two? Why maybe you should choose one over the other? And also, I'll be sharing with you how easy it is actually to start investing overseas. It's not that difficult as we might think. At the end of it, I will also share with you, my favorites among the Malaysian and Singapore banks, and why is that the case. So stay tuned until the end, right? Our usual disclaimer here. So everything I said is mainly just my own personal opinion. Don't take it as please do your own research before you start investing. Okay. A little bit about Value Invest Asia. We are actually an online publisher, so you can see us like an online magazine, and we're honored that we have been shortlisted by SGX, Singapore Exchange, back in 2018 when we got started as one of the top financial sites. We mainly publish through our website and also on Facebook and YouTube, where you can see more of our content, including videos. Okay, so the first thing we want to address first, right? Is it difficult to invest actually outside of Malaysia? It might seem scary if we have not invested outside of Bursa Malaysia before, but actually now it's very, very easy. And most brokerage, even if you have just a normal brokerage account, they should be able to allow you to invest overseas. Sometimes you just need to sign one simple form that you want to invest overseas, and that's it. And you can buy directly even through their electronic platforms. And they will convert the currency, everything for you, and store the stock for you under their nominee account. So everything is quite seamless. And for myself, this is my portfolio. Actually, I shared with my VIA club members. I share the entire portfolio that I have with them. And I own many stocks. I own close to 40 stocks, which I accumulate over the past 14, 15 years. I've been investing in the market for 14, 15 years. And you can see that what I want to show you guys is my stocks is really all over globally, and mostly focusing on the US and Hong Kong market. But I also have some Malaysia and Singapore stocks that I invest as well. So these will be the key markets that I focus on. And I want to show you that, it is easy to have a diversified portfolio, and it helps you actually to mitigate some risks, because like if you can remember back in 2019, last year, right, the Malaysian market declined. The whole market, KLCI was down. But because all my other market rallied and went up, it helped offset the losses a bit. So having a more diversified portfolio can help you actually reduce risk in your portfolio. So something for you guys to think about as well. And why are we talking about banks here? Because I feel that banks can be one of the easiest way to get started investing overseas. There's a very famous quote, right? Money makes the world go round. And you can see that because of the current virus pandemic, people are losing their job. They are spending a lot less, and the economy is really struggling. And it feels, sometimes if we are stuck at home, it feels that almost the world has stopped. Why is that the case? Why do we feel that the world has stopped? When you go out, the cars are so much lesser. It's because money has stopped flowing, right? At least physically, money has stopped flowing. And when money flows, we can see how the world progressing and the economic activity progressing. And who controls the most money? It is the bank, right? Regardless of any country that you go to, it is the bank that controls the most money. And I really see it. I really see banks as just the proxy of economy, because they are giving out loans, and the money from the loan will fuel the economy. So when the banks stop lending, the economy stops also. We see that very, very clearly back in 2008 during the financial crisis. The bank really tightened their loan, and the economy really slowed down very, very sharply. We also see that now in Malaysia over the past few years, because of the property bubble happening in many places, in many cities, banks have also tightened their loan for properties. And you can see very, very sharply how properties slow down. And because property purchase is sort of a signal that economy is doing well, because when people is making money, they're rich, they want to buy more property, store their wealth somewhere. And when the property prices increase, the loan amount also increase. That leads to higher profit for the banks also. They also prefer a booming property market. But for a bank to hold off on giving loans to a property, signaling that they are worried about a property bubble, they want to slow down the growth in that part. And so banks have very, very strong leverage on the economy. And when we're investing in the banks, we're basically betting on the economy, right? They are just proxy to the economy. So if we are optimistic about, say, the Singapore economy, then maybe we should invest in the Singapore banks. It's the most direct way to kind of show that we are optimistic about Singapore. If we are optimistic about the Malaysia economy, we invest in the Malaysia banks, because as the Malaysia economy grows, the banks will become bigger and bigger as well, right? And so today, we want to look at the main question, right? So many to choose from. Which one should we really be focusing on? the overarching question here is whether you are optimistic about Singapore more or you are optimistic about Malaysia more, right? And that should be at least the underlying thesis. If regardless of, we can see that there's so many banks to choose from in Malaysia, but regardless of which one you end up investing in, the underlying should be that you are still very optimistic about the Malaysia economy, and as the Malaysia economy grows, so would all of them, right? Generally. Okay. Before I touch into before I touch into the key difference between some of the major banks in Singapore and Malaysia, let's look at how I actually analyze a bank, right? These are some of the things that I will tend to look at: the valuation, their revenue stream split, their return on equity. We'll talk a little bit about what is that, their loan breakdown, right? And also something called non-performing loan, or NPL, right? And how can we look into what is NPL? The first one, let's talk about revenue stream. Something that I like whenever I look into a bank is I want to check where are they making their money, both in terms of, number one, you can see this is the presentation by Maybank, by which country they are making their money from, right? This one we can see that they make most of their money from Malaysia, and then we have some from Singapore and also Indonesia. So that's their revenue split geographically. But I also like to see where are they making their money from, like which kind of business they are making their money from. This is a presentation from OCBC, and we can see, that most of their money is still making from the corporate world, from investment banking, and their consumer business is actually not that big for them. They also have a very big insurance business here, and OCBC Wing Hang is their Hong Kong business. So I like to see these two parts. So from there, I know where the bank is making their money and how they are making their money, which is important, right, to understand how the banks operate. The next one I want to look at is what we call the loan breakdown. The loan breakdown, we can easily see where are they giving out the loans to, because from a bank point of view, how they make money is still giving out loans, right? If they don't give out the loans, they cannot earn interest on that, and interest income is their main bread and butter of a bank. They give out loan, they earn interest, and that's their profit. And we can see from, this is also from OCBC, their main loans that they give out is from housing loan, also for property, and also to developers for construction and building construction. And of course, we have other things like the more corporate loans that they give out to different industry as well. So this is a good breakdown for us to understand where are the industry that this bank is exposed to. So during say, for example, during the oil crisis, when oil crashes, both a few years ago and also recently when oil crashes, there's a concern that, some of these companies might not be able to repay back their loan. And then how we check if this will impact a bank is we just go to their customer loan industry and make sure that they don't have very high exposure to oil and gas industry. If a bank has very high exposure to the oil and gas industry, then most likely they're going to be impacted, right? So that's how we can check whenever something happen in one industry, and we want to make sure that it doesn't affect the bank that you invest in. That's how we check it. Next one, we can look at the non-performing loans, or NPL for short. This is basically the loans that has been defaulting or about to default, and the bank would kind of put them under non-performing loans and maybe write them off in the future. So we want to make sure that the banks is able to maintain a relatively low amount, a low ratio for NPL, meaning that they have good risk management. They don't simply just give out loan to whoever that comes. They at least make sure that when they give out a loan, the loan will still come back to them. They can still probably get a return from them. So some less prudent banks, how they grow their business is they just simply give out a lot of loans, right? Regardless of the credit rating of the customers. And as they give out more and more loans at the beginning, when things are still doing fine, you can see that their profit really shoot up a lot because they're earning very high interest, most likely. And also these are still at the beginning stage. So most likely defaults or all the companies are still able to pay at the beginning. So they will see very fast growth at the beginning. But this is not sustainable. So what happened is most likely as along the way, then the company will start having problem repairing. Then we'll see some default. And then suddenly they'll have a sharp increase in NPL and they have to write off those loans. And that will be a big hit to their profit. So it's a good way to double check. Every time you see a bank suddenly having reported very high growth in profit, especially higher growth than say what the economy is doing. Because like I said before, banks are proxy to the economy. If the economy is growing like 2%, 3%, but the bank is growing at like 10, 20%, then something is wrong because the bank cannot really grow so much faster than the economy. It kinds of have to grow in line with the economy. And if it's doing things that is different from what the economy is doing, then we can check on whether they are giving out risky loans just to trying to boost up their income. So something to take a note of. And next one is what I call the Warren Buffett's favorite ratio, return on equity. He liked to talk about this ratio, and this ratio basically means it's a measure of how efficient the company is to generate more income for shareholders. So it basically means the shareholder equity with a fixed amount of shareholder equity, how much more profit can the company produce? Because the shareholder equities is basically kind of fixed and growing slowly, right? If a company is worth, say, 100 million, and from that 100 million, how much profit it can generate? So say a company can generate a 10 million from a 100 million equity. It means it has a ROE of about 10%, right? Net income divided by shareholder equities. As this number increase, it means that the company is more efficient in using shareholders' equity, right? They can produce more profit with less. So this typically we want a higher ROE, meaning that the company is more efficient in its operation. And this number, although we can calculate, I just pass you guys the formula for it, but it's very easily that we can find it, right, from many of the data website. Even for Bursa, I think you can find it from Bursa Marketplace. SGX, you can find it from the SGX website, but also you can get it from website like Morningstar. This is just a screenshot for them. I'm not affiliated with Morningstar, but I'm just a user, and this is the main tool that I mainly use. And even with the free version, you'll be able to get this figure, and easily you can compare among different banks which one has a better return of equity and give you a better understanding of which bank is more efficient in generating profit. The next one is the valuation. I leave it to last mainly because this is the valuation is tend to be the last thing that I check. And when I look at valuation mainly for banks, I check on two main things. Number one is the price to book and dividend yield. I don't really look at the price to earnings for a bank, mainly because the bank doesn't earn the same way as many companies. They don't earn from collecting, they don't sell a product and then get back a markup, a return. They earn on interest. And say, for example, your credit card interest, right? The longer you don't pay your credit card bill, the more the bank is actually earning, right? So it is not receiving any cash from you, and yet it is booking more and more profit, right? So typically, because their cash flow doesn't match their earnings, I don't tend to look at their price to earning, but rather I just look at their price to book, because at the end of the day, their book value is mainly still loans and investments that they hold. And so these are future money to be collected. So the equity is what is the worth of the bank. And I like to look at the price to book ratio. Another one that I like is their dividend yield, because dividend is what I get. So that's more important, right? Regardless of their PE might be very low, or their price to book might be very low. But if they are returning most of their profit back to me as dividend, I get the return first, right? I don't need to worry so much of, say, what kind of risk that the bank is holding that I'm unaware of. And all these figures also you can easily find on data website, like this one I share again from Morningstar. And they most of the time they allow you to look at the past record as well, right? The past record as well. And this is for the valuation on dividend as well. So everything is quite easy to look at. So when you're looking for your next bank, right? After today, maybe you want to start looking into banks. Try to look through these 5 factors and look through this information. For today, because I feel most Singapore and Malaysia banks are generally quite conservative in nature. So they don't simply give out excessive risky loans. And so I wouldn't touch too much on the loan breakdown, because most of them are still property based, and also won't touch so much on the non-performing loans. But I want to highlight the key difference between each of them in terms of valuation, revenue stream, and return on equity, so you can better understand which one you might be more interested in to start researching on. So let's start with Singapore banks first, right? DBS. DBS is actually the largest bank in the whole of Southeast Asia. It is also the only government-linked bank in Singapore. They own both DBS Bank and also POSB, which is Postbank of Singapore. So you can see them as the equivalent of Maybank of Singapore. They're Maybank of Singapore. And they have the largest bank asset size in the whole Southeast Asia. And yet this company actually still generate most of their revenue from Singapore, even though they are so big, right? And why is that the case? Because for one, if we think about it, Singapore property is still the highest value in Southeast Asia. So naturally, when they give out property loans, a smaller foot acreage of land or property, they can actually give out much larger loan amount. And because of that, it means actually more business. Say for the whole of Singapore, maybe it's the size, not even the size of Klang Valley, right? But the property value of the whole of Singapore is so much higher than maybe even the entire Malaysia property market. So from there, they are able to give out so much more loans and generate a huge amount of revenue from Singapore itself. The second area geographically where they generate more revenue is actually from Hong Kong. And this is coming from after many years of acquisition of different major banks in Hong Kong, and they consolidate it into Hong Kong. So this will be their Hong Kong business, which is also very, very big. And you can see why it end up that, although it's such a huge bank across Southeast Asia, but they still generate most of their income mainly from Singapore and Hong Kong. Why is that the case? Because these two places is sort of like the tax haven, or the Switzerland of Asia, right? It means that people from all over Southeast Asia and also Greater China, and now more and more even South Asia like India and Pakistan, more and more people are moving their money to these two places because wealthy people around, especially in Southeast Asia, they know that their local currency maybe is slightly riskier to hold. We can just think about, in the past few years, how much ringgit has actually depreciated against stronger currency like Sing dollar or Hong Kong dollar, which is pegged to US dollars. And if you are someone that have some spare savings, you might feel that it's maybe safer to park some of your money in Singapore and Malaysia. So even if they earn the revenue from Singapore and Malaysia, the money might not actually be generated from their customer money might not actually be from Singaporeans or from Hong Kongers. They can be money flow from around Southeast Asia going into these two places. So that's how I see it, and that's why, you know, even though they generate most of their revenue from these two places, it is still a kind of like a Southeast Asia bank, and they are very very efficient in generating return. Their ROE is actually at 12.6%, which is one of the higher ones. There's one bank within this list today that is higher than this. You guys can guess which bank it is, and then we'll review that later. Another interesting point is DBS don't really have a presence in Malaysia, unlike the other two banks, OCBC and UOB, right? DBS don't have a presence in Malaysia, but they have it through a very, very minor investment through Alliance Bank. So they are a small stakeholder of Alliance Bank. I don't know why they never have a presence here. One guess is maybe because they are government linked, and it might be very, very sensitive to actually have a DBS in Malaysia, right? That's just my guess, but so far they have not really, you know, see Malaysia as a place that they want to have a presence in. Okay, so these are the key points on DBS. Let's move on to the next one, which is OCBC. I feel this one we might be right. It is actually a smaller bank in terms of revenue compared to even UOB. The business make up of mainly two key business. It is the bank, but it is also one of the largest insurance company in Southeast Asia, because OCBC owns Great Eastern, and 17% of its revenue is actually coming from their insurance business. Okay, so this is something to take note on OCBC. When you are investing in OCBC, you're actually investing quite a large part in its insurance business. Geographically wise, 54% of their revenue from Singapore. Their next largest market is Greater China, mainly in Hong Kong also, 19%, and also 14% of their revenue coming from Malaysia. So still okay, but you can see that it's quite a step DBS. Next one is UOB. UOB is like I said, I feel that UOB is the only family-owned bank now in Singapore. Why is that the case? DBS is a government-linked company, right? OCBC, yeah, you might feel that it's family-owned, but actually it's owned by Lee Foundation. And as a foundation, they are not really like a family. They're more like a corporation, and they're very, very professionally run, because Lee Foundation is so big, right? In Malaysia, they own Lee Rubber and everything. So they are a very, very big corporation. They're run very professionally. And UOB is the only one that is still directly owned by the Wee family. And the CEO now is actually the grandson of the founder. So still within the family, right? Still run by the family. And I see this as the most Southeast Asia-centric bank among the three Singapore banks. 57% of their revenue coming from Singapore, and very evenly split. The next three market is Malaysia, Thailand, and Greater China, all about 10%. So compared to OCBC and DBS, they have lesser exposure to Greater China and more to Southeast Asia. And their ROE is at 11%. So relatively also quite a very good and prudent, reputable bank. So these are the three main banks in Singapore. Which one is your favorite? Maybe you can share with me on the comment also. I'll try to read them later. But I'll share with you my favorite later after going through the Malaysia banks as well. So these let's go through the Malaysia banks also. Because Malaysia has so many listed banks, I will not go through every single one of them. I'll just go through some of the major ones. But of course, we have to start with Maybank. Maybank is the largest bank in Malaysia. It makes a profit of about 8.2 billion last year, right? It is much more than the second bank. And interestingly, although we see Maybank as like a Malayan banking, right? Malaysia bank, only 62% of their revenue is coming from Malaysia, right? 18.7% coming from Singapore and 12.1% coming from Indonesia. So it has a it has geographically outreach more like the Singapore banks, quite international, right? Not just a Malaysia bank. It's quite international as well for Maybank. ROE also quite reputable at 10.9, close to UOB and OCBC. Of course, not quite there at the DBS level. More tech-savvy bank in Malaysia, right? If you have a Maybank account, you'll realize that they are more aggressive in pursuing digital banking compared to many of the other banks, which I think is a positive because there's no way around that. Digital is the future, and more things have to move to digital. And rather than avoiding it, rather than ignoring it, I feel that Maybank is doing a great job in trying to embrace and make it part of their business as a digital bank. Okay. Next one is OCBC. OCBC, I feel, is the favorite bank among investors, right? For many, many years, it is the favorite bank among investors. People tend to maybe trust public bank more than even the government. Today, it is still a very Malaysia-centric bank. Most of their revenue still coming from Malaysia, 83% of revenue coming from Malaysia. It has overseas business across Southeast Asia, but those are very, very small outfit, mainly through some of the more emerging markets, say like Cambodia and overseas. Interesting part about public bank is it has a very big unit trust business, right? Public mutual is very big. The largest public unit trust business in Malaysia. And unit trust actually generate about 10% of their revenue. So it's a very strong unit within public bank. And what is amazing about public bank is they have very, very prudent management. What I mean is their non-performing loan is actually one of the lowest among Malaysian banks, right? Most banks, their non-performing loans is about 2%. About 2% of the loans are bad loans, but public bank can keep it within 1%, right? Which is very, very amazing. And maybe because of such low their ROE is also amazing. So this is the only bank that has a better ROE than DBS, and which is why they end up being like the investors' favorite bank for good reasons, right? Because they are of a much higher quality compared to the rest of the banks. So this is something you need to know about public bank. Very well run. Next one is CIMB. I feel CIMB used to be quite important bank that among investors, many investors like, but more and more, maybe because of political link, they have kind of dropped off the favor within the Malaysia investors. But it's still a very large bank. And CIMB actually is more of a commercial bank compared to Maybank and Public Bank, which generate most of their profits still coming from the retail and consumer market. Most of the profit for CIMB actually coming from commercial banking and corporate banking, right? And geographically, they're also quite diversified. About 69% of profit coming from Malaysia, 15% from Indonesia, 7% from Thailand, and 7% from Singapore. So these are banks that they have kind of acquired across Southeast Asia during the Nazir Razak era, which they went on a huge acquisition spree across Southeast Asia to become more of a Southeast Asian bank, right? That's their marketing also. You can see from the advertisement, they try to be a Southeast Asian bank. But maybe because of the wider operation as well, it's harder to control. They didn't grow all this market organically. It's more of an acquisition. So maybe different in culture, different in operation. Their ROE is not that strong. Their ROE is actually one of the weaker ones here at just 9.3%. So this is something to note about CIMB. And next one I want to talk about is Hong Leong Bank. But Hong Leong Bank is slightly more complicated a little bit because Hong Leong has 3 listed entities on Bursa Malaysia. You have Hong Leong Bank Berhad here. You have Hong Leong Financial Group. And you have Hong Leong Capital Berhad. So there's 3. So the main one we want to look at today is Hong Leong Bank, because that is still their commercial banking and the main bulk of their business. Hong Leong Financial Group is actually the holding company. They own everything Hong Leong Finance related. So the bank, the insurance, and also their investment banks, everything they own. And Hong Leong Capital is just the investment bank. We focus on Hong Leong Bank because from the whole group, right, they generate about 2 billion in profit. But these two, their insurance and the investment banking, actually generate less than 10%, about 10% of the profit only. So the main bulk of the business still coming from just a commercial bank. So which I feel is more important, I guess is more relevant for us that just focus on the Hong Leong Bank itself. And Hong Leong Bank, they are very, very focused in Malaysia business. The overseas business actually less than 5% coming from Hong Leong Bank. But they have quite a few strategic investment, and 18% of their profit actually coming from this associate in China, their Chengdu Bank. They own a portion of Chengdu Bank, and that generate about 18% of their profit for them. So this is, you can see this as a Malaysia bank with major investment in Chengdu Bank. Their ROE quite decent at about 10.8%. So still quite a decent bank. And the last one, let's talk about RHB Bank. RHB Bank, I feel not too special here compared to all the other banks. They are very, very focused in Malaysia. Their business still mainly from Malaysia. They more than 90% is coming from Malaysia. They have a very small Singapore business. In Singapore, we don't hear much about RHB Bank at all. Then their ROE also, in the mid-range, about 10.3. So I feel this is more of a straightforward bank, just a bank that is focused on Malaysia across all sector. Nothing too special about it. Okay, now let's talk about the more interesting part, which is valuation. You realize why I put it at the end. Because I'm trying to show you my whole process of how I analyze and look at banks. And typically, I would only look at valuation right at the end when investing in a company. I never look at the valuation first when I analyze a stock. So I don't go and see, wow, which are the cheapest stock, and then I analyze it. I actually look at the company first and make sure that it's a company that I like and it's of high quality, and I feel that this company has potential in the future, and I like it as a business first, and then I look at the valuation to see when is the better time to invest in it. So as I mentioned before, valuation for banks, I tend to focus on 2 key things, which is price to book, number 1, and also dividend yield. So for price to book, we want something to be lower means cheaper, right? Because equity is, say, the entire amount of few loans and asset that the company has, but price is what we pay. So we want to pay as less as possible for the same amount of asset, for the same amount of equity of the company. Typically, a bank tend to trade, around 1 to 1+ times of their book value. You can see now, because of the current pandemic and a slowdown, most of the banks are very, very cheap all over the world. Even for Chinese banks or US banks, they're all trading very, very cheaply. The Singapore banks now, they are trading at about 0.9, 0.8 times book value. So the cheapest among them is OCBC at 0.82. Malaysia banks have a wider range. You can see public bank has always been more expensive in a way compared to other banks. Their long-term price to book is actually 2 times. So they actually come off very, very sharply to just 1.38 times now, right, compared to their long-term average. Maybank is about 1, CIMB about just 0.6, RHB about 0.75, and Hong Leong also around 1 times. So these are the book value valuation of all the banks, and I guess the cheapest one among them now is CIMB, and the more expensive one is Public Bank. But that doesn't mean that we should always go for just the cheapest one, right? Valuation should just be one part of the criteria that we look at. So from just now, everything that we talk about, and then you consider the valuation as well. So I might not just go for the cheapest one, because sometimes the cheapest one means that they are cheap for a reason. And we can see that because CIMB has a much weaker business, much lower efficiency in their ROE, which is why maybe they deserve to be cheaper than the other banks, And also just let's look at dividend yield. Dividend yield is always fluctuating, but at the moment, they are all very high dividend paying, with the highest one being Maybank at 8.6%, but all the Singapore banks is giving you about 5 to 6% dividend yield as well, which is very attractive, especially Singapore has a much lower interest rate or fixed D rate compared to Malaysia, right? That's very attractive. And the rest, Public Bank is, of course, have a much lower dividend yield. And interestingly, Hong Leong also has a very low dividend yield as well. But like I said, dividend can change. A company can, cut their dividend, or maybe slow down the growth of their dividend. And during these volatile times, I think the dividend will shift quite significantly as well. That's something for us to take note of, right? So which one would you guys choose? Which one would you guys choose? Maybe you can let me know as well, which one do you prefer? But from my own selection, and after looking at all these banks, first, as a disclosure, I would say that actually I don't own any of the banks that we talk about today. I don't own any Singapore or Malaysia banks, but we can discuss that if you want during the Q&A. But if I am to choose, these are the two banks that I am more optimistic about. Number one is UOB, and I like it mainly because it is more focused on Southeast Asia, right, compared to OCBC and UOB. And I like that in a Singapore bank, because if I want to just invest in, because I feel that China is growing and Chinese banking sector will be bigger, I can just invest in the Chinese banks directly. I wouldn't need to invest in a Singapore bank or even a Malaysia bank just to get exposure to the Chinese banking sector, right? I can buy the Chinese bank directly. So when I buy a Singapore bank, I might want to buy it because it has something that other stock cannot provide me, which is Southeast Asia exposure. And UOB is one of the one that has high exposure to Southeast Asia, very consistent, and the valuation is quite attractive right now as well. Maybank is another one that I like, mainly because it is the largest bank in Malaysia, and I feel that it has done very well throughout the past few years. Very diversified business, which reduce my risk, and have a strong and reputable ROE as well, right? You can see why I don't tend to go to the cheapest stock that I can find, which is sort of my, I guess, philosophy in investing. I don't believe that we should always go for the cheapest. Sometimes things are cheap for a reason. I rather choose quality over price every time, right? So if I have a stock that is extremely high quality, but maybe not trading at a very cheap valuation, I might still invest in it. But if I have a company that I feel is not that great a business, even though say today they're trading at very, very attractive valuation, I might still pass on it. That's my way of thinking about it. And it's very very similar to how we actually shop for things. Say, for example, if you are shopping for a new phone, I recently just bought a new phone, right? I recently just bought a new phone 2 weeks ago. And how I shop for it is very similar to how I shop for stocks. I don't just go for the cheapest one, right? I scroll through Lazada. I don't, this one cheapest, I will buy that one. Not really. I go through and make sure, reviews after reviews to make sure which one has a better quality, maybe fast enough for the things that I want to do. unique enough, special enough that give me some identity as well and holding the phone, but still value for money. So that's the way I both choose a stock and also a phone, right? This kind of analogy of how I guess we should be thinking about when we are shopping for stocks. So thank you very much. Apart from all this I share, I think I'll give you guys the link here to download this PDF, this presentation, and also we have a free dividend stock guide for you as well. There's 5 more dividend stocks that you can go through as well. Apart from the banks that we discussed, you can also check them out. Just go to valueinvestasia.com/note, N-O-T-E, and you'll be able to download it. And if there's some part of the presentation which you feel that you don't quite follow, and you want to learn more about what is investing and my style of investing, then I'll provide a link there as well, where you can have a free video course that we talk about how to get started in investing as well. Maybe you can take a screenshot of this screen right here, and we can go back to Ethan and we can go to the Q&A now. Ethan, thank you.
Okay, great, Stanley. All right, guys. Okay, so I think in the link where you view, there's a place where you can put questions as comments. And right now, let's take a look at that page. All right. So I think the very first question to Stanley is, people asking, there's this attendee who asked, do you think banks will drop their dividends in the current low interest rate environment? And if so or not, how about the price?
Yeah. So you can see that during our in the presentation, most of the banks have very, very high dividend right now. I actually do feel that maybe we will see some cut in dividend, mainly because during these few months, right, we can see that the government, both in Singapore and Malaysia, is pushing for extension in repayment of loans. So the cash flow for a bank is getting tighter and tighter, and they might want to preserve that cash flow. So that might be something that they look at and maybe cut some dividend. And even if they don't cut, I feel dividend growth will be quite slow, which is why I wouldn't base so much on the dividend yield itself. In terms of valuation, I don't think they would be greatly affected because investors sort of already know, things are not doing well. Having a dividend, say Maybank of 8.6%, is good, but highly unlikely it can sustain for so many years. But the valuation is also very cheap, right? So I would say, if you're saying that is it a good time to start looking at banks, if you are a long-term investor like myself, sometimes when I buy a stock, I can keep it for 5 to 10 years. I will just put it there. If you have such a long time frame, it's definitely still worth looking at as well, even at this point.
Okay, thanks, Stanley. Okay, I think there's another question. So there's the question of banks being an indicator of like the economy's health, right? So this attendee asked, how do you think the economy will be like,
Right.
I mean, it's a general question,
yeah.
but yeah.
Yeah, I don't have a crystal ball. But what I would say is how the economies react and how the stock market will react is actually two different things. Sometimes we feel that the stock market would always go together with the economy, but that's not really the case, right? In 2008, during the financial crisis, the economy was still getting better, right? Even until 2009, economy really only started recovering in 2010 and early 11. But back in 2009, we are already seeing the bull market started. Similarly, in today's case, especially in the US market, things are very, very bad in the US. And yet, almost every single day, just after a short, like 3 weeks drop in the US market, very sharp drop in the US market, they recover just as strongly. And today, US market is still making, record breaks almost every single day. Why is that the case? Because it has to do with how the central bank is reacting to the market. In the US, they are very, very aggressive and saying almost that, regardless of what happens, we will support the economy, right? Unlimited amount of QE going to be pumped into the system. So with unlimited amount of money being pumped into the system, then there's no, almost that it creates no fear in investor, because no matter what, there's going to be money there to support the economy. Not so much in the Singapore and Malaysia case, especially in Malaysia, because it's a very relatively new government, and for many, many years of quite bad corporate governance and operation wise in the Malaysian government, we don't have that big of savings, with us. There's no unlimited amount of money that we can pour in. Plus, Malaysian ringgit is not the world's currency. US dollars can print as much as they can, and the world can absorb it because it's used worldwide. Malaysian ringgit is not used worldwide. If we start printing unlimited amount, then inflation will start kicking in, right? And we will have maybe a hyperinflation issue, sort of what Indonesia tend to have over the past decade. So I'm more pessimistic about how the economy will try to recover. I think it will take a longer time compared to major markets like China and US. I think Singapore and Malaysia, they will recover, yes, but it will be much slower and more painful in a sense, which is why, again, why the valuation of all these banks are much, much lower. You can look at public bank also, from most of the time, the price to book is 2 times. It dropped to 1.3 times. Now, that's a very sharp drop, which is a reflection investors feel. And now, you are basically choosing between, am I pessimistic enough to feel that the economy is going downhill, or am I comfortable with the fact that I'm getting a bargain now in these banks at a very low valuation, even though the economy might not be doing that well, but I feel that in the long run, it can recover, right? So sometimes when things are good, things are going to be priced expensive also, right? You cannot have a best of both worlds when economy is booming and very clearly that we're going to do well, and yet valuation is so cheap. And that's why, because valuation is so cheap, because economy is not doing that well. So you have to do the trade-off here when it comes to choosing your investment decision, I feel.
Okay, thanks, Stanley. All right, another question is, this attendee asks, what will happen to bank stocks if countries go into negative interest rate? Yeah.
We've seen that in Europe. People feel that it's going to be bad for the banks. Not really the case, right? It's not really the case. They would not be able to earn so much on interest, right? But you can see a lot of banks are now moving to more fee-based revenue as well. So they're not relying so much on interest income as well. Plus, as long as they can earn a spread, meaning this is what we call net interest margin. Net interest margin. What net interest margin is basically because the bank has to borrow money as well. They either borrow from us when we put in our money inside and they give us fixed D. So we're basically borrow money to the banks, or they can borrow from central banks or other banks. They borrow among themselves. So if the borrowing cost is reduced, right, even though they are lending out at a much lower rate, as long as they can maintain that net interest margin, which is NIM, that net interest margin, say maybe 2%, their profit actually is not affected. Actually, it's not affected. How it will affect them is actually if the economy, because it's going to negative rate, maybe people would start to invest more because we see that wow, funds are so cheap. I'll start a new business, I will buy more properties, and hopefully that will restart the economy again. And that's actually become a good thing for them, right? So in the short term, as we dive into negative interest rate, it might affect the bank slightly, but I will feel it's short term in nature. But if negative interest rate do what is intended to do, which is help to regenerate the economy, and when we see the recovery of the economy, then that's good for banks.
Okay, thanks, Stanley. Okay, another question, right? So a lot of okay, so this attendee sort of follows you. I think he knows that you're actually investing more in the tech sector in the US rather than bank stocks, right? So he asked, don't you think the valuation of tech sector has gone quite a stretch now? Yeah.
Yeah. So first of all, thank you for following me and my work. Yes, if you follow my work, I tend to talk quite a lot on tech sector, both in the US and also in China. Yes, their valuation is very high compared to especially banks. I think banks' valuation is quite low. But when I invest, I sort of have two groups of investing style. One is mainly focused on the growth potential, and the other one mainly focused more on, say, for income or more stable stocks. So I still also have stocks that I invest for stability and for because they are more reasonable in valuation, right? I own some Chinese banks. I also own what else is cheap? I also own some consumer companies that is quite low in valuation. But I invest in tech stock because of the huge growth potential. Mainly because I really feel that the growth sector of a tech stock is still far from over. The addressable market, we're just at the start, I feel, that of really restructuring the whole economy around creating the digital space as the main space of commerce compared to brick and mortar. Right? In the past, if we want to buy, say, anything, we want to go to a department store to buy something. But now, we might browse around from our mobile app first. And even if I end up going to the store to buy, I will be able to find the information first online and then choose what I want. So the decision of shopping is already done on my phone or on my computer rather than on the shops. So maybe the shop's experience or the shop doesn't need to be so fancy and everything, but rather the website need to be very fancy, right? Or the online experience need to be very, very fancy to entice me to make that decision. So I feel we're still on that shift. You've seen that Facebook has recently started Facebook shops, right? That's another move. And I feel more and more, even for restaurant now, who would have thought that restaurant need an online presence? But now it's proven, even in this pandemic, even restaurants need an online presence in the market. And we are far from over from this kind of, I guess, recalibration of the economy, which is why I feel the growth potential of tech stock still far outweighs the valuation at the moment. Yeah. Great question.
Yeah, great, Stanley. Okay, we have one final question. We only have 5 minutes left. So attendee asked this question. Should we be concerned about the currency risk when investing in Malaysia bank? This question, I think he should be speaking from a Singaporean point of view.
Yeah. So maybe I answer both ways. Ways because if you are Malaysian investors also investing in Singapore banks, there's a currency risk as well, right? The answer is yes. You would have some currency risk, especially if, say, you're buying into a bank that is more local centric. So for in Malaysia case, maybe you invest in Public Bank or Hong Leong Bank or RHB Bank. Those are purely more Malaysia business. So they generate business here. And as the, say, if ringgit depreciate you will be affected on the currency risk as well. But it's the same way around. But although in the long term we have seen that Singapore dollar tend to appreciate compared to ringgit, but might not always be the case. That might not always be the case. And in a way, when we invest overseas, it's a way to diversify away from our basket of stocks. So if everything that we invest is only in our home country and we work in our own home country, if anything happens to the economy of our home country, it means both our job, our livelihood will be in danger, and our portfolio also in danger. But when we have invest overseas, regardless of whether you are Malaysian invest in Singapore or Singapore invest in Malaysia, if anything happens to, this is touch wood, but if anything happens to your home country and your job livelihood, at least your investment portfolio is have some diversification. It doesn't fully correlate with your job or your country. You can lose your job or something happen to your country, but yet your portfolio is still doing well, right? That's the way I see it. So it's not always about maximizing the return where I can get the best return, but rather thinking about how I can mitigate some of my risks in my life as well.
All right. Thanks, Stanley. Okay,
Right.
I think we're about time. It's 10:57 right now. Thank you, Stanley, so much for the incredible presentation and also the insights and the answers to the attendees' questions. So
Okay.
I think we will have to end this webinar here. So thank you everybody for attending this webinar. I know it's early 10 a.m. On a Saturday, but I think it's worth the time to hear Stanley speak about the topic. And if you have any questions, you can let Stanley know lah. Okay.
No problem.
Thank you everybody. Thank you, Stanley.
Thank you, guys.
Stay tuned
See
for
ya.
the next webinar at 11 a.m. Thank you guys. Bye bye.